ladies and gentlemen. Thank you very much for making time for this conversation. It's a fairly important one on things that are keeping some of us awake at night for very long periods of time. Questions around debt, inflation, currency issues, currency volatility, access to the dollar, de-dollarization in some parts of the world. That's a fairly in vogue conversation. Whether or not it has any legs, that's a separate story altogether. We'll be covering all of these topics in a bit of detail this afternoon. We hope to cover them in the next 80 or so minutes with the aid of my distinguished panelists. I'll get to introduce them in just a moment, but to set the stage first and foremost, I'd like to bring up Aurélien Maly from Moody's to set the stage for what we'll be discussing on what we owe, who we owe, and how we're going to deal with many issues around paying it all back. Aurélien, the stage is yours.
Hello. I know that it's not almost the last session, but as the moderator said, this is very important to talk about this issue of the debt. So we have a presentation, and I'm going to try to use the slide. I would like to start with, so it's an 8 minutes presentation, so I will go fast, but it's very important to set the stage. The debt on the continent now is at level we have seen in the past, early 2000, when you had all the debt reduction initiative, EPIC and MDRI that were implemented, and that successfully reduced the debt stock on that level of African countries to 30% from 60% between 2000 and 2010. At that time, it was possible to do that, and because the creditors were relatively not diverse, and there was a clear view that at 60%, it started to become unsustainable. So the question of the debt sustainability is really back on the agenda because we are back to this level of 60%. But today, the situation is much worse because you have a diversity of creditors that prevent maybe some of the solutions that were put in the past. But also, there are questions about the elevated liquidity needs in a period where the premium and the risk premium are reappraised by the international market. So you know all that 60% of countries on the continent are positioned by the IMF into the high risk of debt distress. And we rate 148 countries at Moody's, and a quarter of our sovereign ratings are in CAA category, which means that we expect loss. So this topic is really, really important. Now, when we look at Africa, the public finances have significantly deteriorated, and I put these two slides, two charts just to show how far the deterioration is. The first one shows the deficit since COVID, that's the red bar down. And you can see that it's more difficult to do fiscal consolidation, at least our expectation, in Africa than elsewhere. It seems that the deficits are going to remain high for longer. And I'll come to that a bit later, why the deficits are challenging in Africa. And the right-hand side chart shows the interest payment to revenue. The red bar is the African countries. And you can see that over 10 years only, the interest payment to revenue moved from 4% of the revenue to more than 12%, and it's a median. 12% is very high. It means that many African countries spend more on servicing the interest on their debt than they spent on education or health, on very important expenditure. And what is important also to note is that I left other regions like LATAM or even the advanced economies, the lower, the lower, the one that is at the bottom, you could see that during the crisis that we witnessed the last few years, they increased their deficit, but the cost of the debt went down. And it's where it's important to understand that the shocks that we had, COVID, the global inflation shock, are really more negative for weaker credit because they borrow and they borrow at a much more costly interest rate. So I put two charts on external vulnerability, inflation pressure, because it's very important to understand that the shocks that occurred have really deteriorated the external vulnerability, the external position of many countries. So the chart in left, when you look at Africa, it's the small red dot. It seems that the shocks have not changed when you look at the delta of current account deficit pre-2019 to today. It seems not have moved. But you have a very different story when you look country per country. The oil exporter, the large exporter, commodity exporters, they have current account surpluses or delta that are positive. But many countries have delta structurally that are negative now, meaning that they need more external financing to, or there is a lot of pressure on their reserve to fund this deficit due to the shocks that have really impacted their external position. And when you look at inflation, this is the same. Inflation on the right-hand side, you see a level of inflation that is, in terms of delta, around 6 to 7% more inflation in Africa than before. What does it mean? It means that, and it also explains this persistence of inflationary pressure, why the deficits are more difficult to tackle. Because governments, they try to protect the more vulnerable, and therefore they suppress some taxes, for example, on energy, or the subsidies are increasing. And that explains also this element of social risk that the governments have to take into account, why the deficits are more challenging to tackle in this environment. So, and unfortunately, at the time where, as we just seen, you have larger fiscal deficit and you have larger external need, it's exactly the time where the international market is more challenging to access. And on the left-hand side, we put a list of all the countries that issued Eurobond when during the last decade, when the yields were compressed. And these bonds are coming to maturity, and you have very large bonds like the Kenyan bond of 2 billion next year. While at the same time, when we look at the graph on the right-hand side, you see in red the risk premium for African sovereign going up. But what is important to look at is that it's diverging from the peers. In blue, we put the average Latin yields, and in green is the U.S. 10-year treasuries. So that is worrisome because it means that the market is pricing the risk for African issuance higher and higher. And so it makes very complex for the government to secure enough external liquidity. And the bonds that are coming due over the next few years will have to be either rolled over or paid if the countries remain.
So I wanted to really explain all that, to say that it raised a lot of questions that the panel and I will try to answer. In particular, how to make sure that over the medium term, public finance management really improve. This is absolutely key. Because it's only on the long term that you manage your public finance when you have a 5-year plan, when you know your capex, how you deploy the capital investment and the project and the strategy, and how you also raise your revenues efficiently. Also, given the current tightening of external liquidity, there is a need to think of new ways to support the most vulnerable sovereign that face the difficulty of raising external financing. It may go also, part of the solution is to develop the domestic capital market, but it will take decades probably. And therefore, the sovereign debt restructuring is clearly more challenging today. And if we have so many ratings that are in the CAA, especially in the region, it's because there are reasons behind it. We are going to discuss that during the panel. So I stop there.
That works. Merci, Aurélien. Appreciate it. Actually, please stay as well, because we're going to put you on the panel in just a moment. My name is Rama Nyang. I'm a Kenyan business journalist. I work for CGTN and for Bloomberg. And I'd like to bring up my distinguished panelists up to join me for this discussion as well. I'm going to start with Professor Carlos Lopez, probably about as close as we get to an academic rock star in our part of the world, I believe. Fair assessment? 100% fair, I think. Professor Carlos Lopez joining us here. He's a professor at the University of Cape Town and Sion Spo. Ruth Brower of TCX Investment Management. Please come up to the stage as well. Mustafa Sow, CEO of SF Capital, will be making a very interesting argument in defense of taxpayers. Please come to the stage. And finally, a man whose position, frankly, I don't quite envy, because we're going to be firing a lot of questions his way today. Abebe Emre Selassie is the head of the Africa Department at the International Monetary Fund. Thank you very much. Okay, let's start with a relatively broad question. To go back to, I think it was the second last slide that was in Aurélien's presentation. And we've spoken about this a fair bit of, several times in my line of work. We are concerned about the wave of Eurobond repayments that's due in 2024, 2025, and that really is top of mind, especially after Ghana's default, Zambia's default as well. But beyond that wave of repayments that's due 2024, 2025, are there other parts of debt in African sovereigns that we should be concerned about? Professor Lopez, let's start with you.
Well, I don't want to disagree with Aurélien, but in fact, part of the assessment we had is self-serving, in the sense that it does protect those who believe in the rating agencies' ratings. And, by actually having a more negative view of some of the possible developments, it's self-fulfilling, because, in fact, it does create an image of difficulties in Africa. It doesn't matter for a country to grow above 5% to get liquidity. You just don't get it. And you don't get it, it has nothing to do with elements that have to deal with the domestic efficiency, which absolutely necessary to go through. You have to increase the fiscal pressure. You have to do all those things. But we have to admit that most of what has happened since 2019 has been provoked by exogenous shocks. And this is actually quite clear in one of the tables that Aurélien presented, because in 2019, the position of Africa and the difficulties were very different from what they are today. And the reason is that, in fact, when you look into the sovereign debt crisis, it is a global crisis. It's not an African crisis. You have $86 trillion of debt in the world. You have, according to the Bank of International Settlements, about 80 trillion that is hidden debt that is not actually appearing because it's denominated by non-bank institutions. And if you look into the debt of Africa, we are really talking about 877 billion or something like that. If you look into the GDP of Africa, it's really a ridiculous amount. Why is it so important? Because we can't really fulfill the obligations of our debt servicing. And despite having a record of actually support from institutions like the IMF, I said to my friend Abebe that I was going to praise him because they are doing an incredible job of trying to uplift as much as possible the lending of the IMF. Despite that, we are talking about numbers that really don't help Africa. So it has nothing to do with macroeconomic performance, because if you look into indicators, well, let's just compare with Ukraine. Ukraine just got this year, and we are in the middle of the year, already 53 billion. Compare with the 29 billion that we got from the IMF for the whole of the continent during the pandemic and the war in Ukraine impact, apart from the 33 billion from SDRs. And you can see that we are not treated equal. And it has nothing to do with the fact that we have macroeconomic indicators that are vulnerable. Yes, they are. But they are because if you look into the deltas, if you look into the curves, they are provoked by exogenous shocks. The problem is that Africa doesn't have access to the liquidity that others do.
And we will get around to the question around fairness, especially with respect to ratings a little later. But I want to come to the private sector perspective. Ruud and Mustafa, what worries you? What keeps you up at night with respect to African debt? Should we be concerned beyond Eurobonds? Because Eurobonds are one thing, but beyond that, are there other monsters lurking in the dark?
Well, actually several issues, but I'd like to jump in what you just said about the exogenous shocks, because that is, I think, the key issue. So when you look at debt sustainability, especially debt sustainability today for Africa, the fact that it is such an issue is that, and I'm now referring also to the first point, how do we want medium-term public finance management to be improved? That African sovereigns do not have the option to actually manage their public finances in terms of the debt service they have to predict, because they can't. 60% of African debt is in dollars, euros, SDRs. It is not in kwacha or in naira or in shilling. So the key issue there is the moment there is an exogenous shock, and it can be the invasion of Ukraine, it can be COVID, it can be an American financial housing crisis, everybody withdraws their funding from frontier markets, including Africa. Frontier markets currencies tank. At that moment, the debt service in local currency for African governments shoots up at the worst possible time. And the moment the debt service shoots up, the rating agents will also see, oh, this is going to be a problem. So you get a downgrade, so you need an increase of interest rates, and you enter in what we call a US dollar debt doom loop. So any exogenous shock will hit frontier markets the hardest, will automatically start a series of events that in today's environment will lead to defaults. And from TCX perspective, what we believe should be the solution for that is, yes, you can of course pay dollars or SDRs or euros to African governments, but then you need to take away the FX risk. You need to take away this pro-cyclical character of hard currency lending and let African governments pay at their own interest rates, and these are higher, but de-risk from the dollars. So the dollar risk should be concentrated elsewhere.
And we'll get to solutions in a moment, but Mustafa, your views on this before I come to the IMF.
I think Ruud has said it. If you look at the debt level, the main driver has been the FX rate. I think Ghana is a perfect example. It has been one of the most performing economy in Sub-Saharan Africa. But the reason why they're struggling to have this issue is mainly because of FX risk. And that brings me to the questions of the role of institutions like IMF with helping African countries. There isn't a standard issue across Africa. All African countries are put into one box, and that is problematic. And the reason why I'm saying this is, if you look at external debt, the policy that the IMF has put in place with regard to external debt has been standardized. If you are Nigeria or Ghana, you are borrowing in US, a country like Ivory Coast and Senegal borrowings in euro will have the same treatment. And I think that is not fair. The reason why
That's not even reflective of the structural differences between the two.
that's exactly because in Ivory Coast and Senegal, they have CFA. CFA is pegged to euros. So if you borrow in euros, you don't have the same exposure to FX risk than the ones that are borrowing in dollars are having. So when you put them under the same policy, you're penalizing them. Now, what's the benefits of being in a zone where your currency is pegged to a certain currency? And that is a huge problem. And not only that, adding to a certain that, look at the BOAD, which is the regional banks, 100% owned by these 8 countries. And now the IMF is saying, the governments, if your borrowings with the BOAD is going to be treated like the same that you're borrowing in dollar or in euros. And BOAD is providing loan in local currency. So when you add all those policymakers in addition to it, you're really penalizing these governments. And these are the things that are adding pressure because you push them to the local markets. We all know that the local banks are not liquid to support infrastructure. So what's going to happen is you want to build a road, you ended up taking a 7-year, 2+5 loan at a 7-8% rate, because that's what the reality is, compared to getting an ECA financing that could give you the joy to benefit 5 years repayment and 10 years. So for me, these are the issues that add to the existing issue that the war in Ukraine or the COVID has added to the sovereign debts in Africa.
You're going to need this one, or you already have one. Okay, perfect. All right. So we've heard the views, right, from academia, from the private sector, but when you released your last assessment on sub-Saharan African economies, the focus was the big funding squeeze, right? There's this contraction in the availability of liquidity at a decent price, right, for the market, for issuers right across the board. But beyond these concerns we have about Eurobond servicing and also servicing domestic debt, which has come about partly because of what happened in Ghana, are there other things that keep you awake at night?
I think that's a big enough issue to keep me awake and don't need to add a lot more because that's at the core of our work. So, just a few reactions to the presentation, what has been said, and maybe a few responses also. So I hope you will bear with me. So I think, one thing I raised my eyebrow when I heard from Aurelian that the situation now is much worse than 2005-06 when the last time debt to GDP ratios were as high. I think this is a bit ahistoric, and we have to think about also what. First of all, really important that you have to assess debt situation on a country-by-country basis, and there's no such thing as, of course, African level of indebtedness, because the heterogeneity, as one of the other presentations, one of the other slides showed, is tremendous across the region. So we have to pay heed to that. But second, I think it's really important also to recognize that our countries are in a much, much better position in terms of the macroeconomic health, institutional quality, societal development, human capital now than they were 15, 20 years ago. So all of the spending that has taken place, all of this increase in debt has got us quite a lot of investment in human capital, in infrastructure, and has put our economies in a much, much better position than they were 20 years ago. So if you only look at the debt side of the balance sheet, you don't recognize, you don't appreciate this other side, and that's, of course, tremendously important when you want to look forward and assess sustainability issues. The key weakness, I think, is that our countries have not done enough to collect enough revenues, enough tax revenues, to be able to service debt as comfortably as they were able to in the past. And I think, so this is a problem, and so I think more of a balanced take is needed in terms of understanding what the challenge in the region is and how we can overcome the difficulty. Second point I wanted to react to a little bit quickly also is, there is all these stories about, a wall of Eurobond repayments and how our country is going to be able to do that, etc. I think this wall of repayment has been there forever. And what is problematic right now is that external markets have been shut, as Carlos was saying, not for reasons that have to do with Africa, but more for exogenous factors. We're in a risk-off environment, you know, the tightening of global financial market conditions. If it persists this way, yes, it will be a problem. So we have to think about how to reprofile, how to roll over. But really, really important, you know, what the fundamentals are what matter in terms of debt sustainability. So the question
is your base...
Let me finish. Sorry.
Is your base assumption that those tighter conditions are going to be there, at least in the medium term?
It's really uncertain. We don't know. But the point I wanted to make is, you know, how to distinguish between a solvency and a liquidity problem is whether the government is doing the required reforms to put, you know, move the deficit to a level that will make debt sustainable on a forward-looking basis. If that's the case, you know, there's exceptional financing from institutions like mine that will be available. There's also other ways in which the financing can be rolled over, okay? So you cannot kind of just look at repayments and assume that there will be a difficulty. And a lot will depend on market conditions at that time, but also whether the fundamentals are continuing to improve. So that is, you know, in and of itself, it doesn't tell us a great deal. Last point I wanted to react a little bit to is this point on the IMF not distinguishing between one country or another, or you know, the basis on which we think about debt sustainability, etc. I mean, you know, if there's one thing that we are somewhat good at, it is, of course, that we prepare, you know, again, going back to the earlier point, we think about very, very, you know, clearly about each country's debt sustainability on the basis of what the outlook for individual countries is. So I take a little bit of umbrage at that point. And then on this issue of FX treatment of foreign debt, we don't actually use the currency. We use the residency as the criteria. Okay, so, you know, we are agnostic whether you're borrowing, you know, in dollars or euros. If your creditor is domestic versus external is really what determines whether debt is external or domestic. So that's a little bit of a different take that we have on that.
One of the main points that I know emerged from the big funding squeeze report was, and this is a point that you've been making, and not just, you know, you, the IMF, but the World Bank as well. There's been a consistent refrain that, you know what, we do need to improve tax collection efforts across the continent. I think the median tax to GDP ratio across the continent is around 13%. Obviously, it varies significantly from one country to the next. But in my reporting, I walk around talking to entrepreneurs, businesses, some of whom perhaps might be here. You're seeing it showing up in consumer spending. Households are not spending as much. COVID came along, destroyed jobs, hundreds of millions of jobs across the world, across Africa. I believe the number was something along the lines of 38 million in the middle of the pandemic. Given everything that's happening, currencies under pressure, inflation at levels that we haven't seen in, you know, 10, 20 years in some places like Ghana, Nigeria, Kenya's also dealing with its own issues. How much room is there really to actually say that, you know what, you need to improve your tax collection levels? Where's that money going to come from?
Really good question. So I have, you know, I'll try and answer this in two ways. I mean, first, if you look, you mentioned Kenya, but several other countries, the level of tax, you know, the tax to GDP ratio now is lower in Kenya than it was, say, in the 90s or early 2000s, okay? Kenya was famous for collecting 19-20% of GDP in taxes. Now it's closer to, I think, 14-15% last time I looked.
Yeah, give or take, 15-16%.
Yeah, so it's lower. I think what has happened is that the structure of our economies has changed tremendously over the last 20, 30 years, but the tax system has not kept pace with that. Yeah? So before, kind of in a way, you had a tax structure, you know, tourism, manufacturing. I mean, it was these big firms that you knew you could identify easily, somewhat easily, better than is the case now, where a lot of activity takes place virtually almost, and a lot of income is generated, you know, like the SA mills in Kenya and all of that. And you know, the tax system is not caught up to that, I think. So there's one issue, which is the structural issue of the activities that are generating GDP not being amenable to taxation that we're facing in our country. So there is that issue.
If I understand you correctly, might that also be a problem with informality? We have a much bigger informal sector.
I'm not sure that, you know, informality is necessarily bigger than it was 20, 30 years ago, but certainly I think the measured GDP is higher, but the tax-paying GDP is not as high. I think that's one answer. And then the second one really comes down to, something I've been calling a fiscal trilemma that many of our ministers, many of our governments are facing. So we as a population do not want to pay taxes, and yet we ask governments to spend more and more on infrastructure. Okay? And then when debt goes up, we're also screaming, saying debt is going up, debt is going up. Or inflation is going up because governments are seeking recourse to monetary financing. So the question is like, how do you solve the problem? And in my view, the least harmful way and the sustainable way, of course, addressing this is through higher tax collections rather than more inflationary financing or more debt or cutting spending, which of course would be detrimental to development. This is easier said than done, absolutely. I mean, of course, already there is quite a bit of pressure, but I think there are also new ways and new things that could be done to make sure that countries have a fairer and more resilient tax system, and I think that has to be pursued.
Professor Lopez, do you want to weigh in on that question? Around tax collections, raising our tax to GDP ratios, where's the money going to come from?
I'm eager actually to comment on that. I agree with everything that Abebe said. But there are three elements that I think are to be included in that discussion. The first is the fact that we have national accounts that are not up to date in most countries. So the structure of the economy has evolved significantly, and we are not coping partly because we don't have the instruments and the knowledge and the information that is required. And if you look into the number of countries that have the national accounts up to date, we are probably around 18 or so in the continent, which is really dramatic. So when you have rebasing exercises like in Nigeria, you actually discover that your tax collection is lower than you thought. And that's what happened in Kenya, and that's definitely the case in Nigeria, which is sort of a scandal, because for an economy that size, being the biggest in the continent, you have a fiscal pressure of about 5 to 6% or something like that. So that's really horrendous if you think that the average in the world is 35% and the average in Africa is around 16%. Now, the second element that I think is part of the discussion is what I would like to push as the idea of fiscal sovereignty. Because you have more and more activities that are highly valued, like in the digital world, under which we operate, that the African countries don't collect enough. And most of the decisions are being done with sort of unilateral managed solutions, mostly propelled by richer countries. Like for instance, for the major tech companies, the deal was done at the G7, then it was socialized at the level of the OECD, and then now it's adopted by the rest. But it's basically a deal that is not fair to Africa, and a country like Kenya actually is challenging it. So you have this problem that is going to grow, particularly with unilateral decisions in regimes of trade that are changing so fast. Like for instance, you have the European Union putting in place a carbon border adjustment mechanism that basically is a unilateral decision to tax carbon intensity, is going to affect Africa. And it's our number one trading partner. So we are losing fiscal sovereignty. And we are losing fast. And of course...
we're losing fiscal sovereignty to countries that we borrow money from.
Yeah, and then of course, the ones that are benefiting are the same countries that we are borrowing from. And then the third element, it was mentioned, but I want just to reinforce one angle, which is the fact that we are asking for countries to basically collect more taxes at a time where the populations, the enterprises, the businesses are overstretched after two major crises, the pandemic and then the war in Ukraine and its impacts. So it's not the right moment to have that discussion, although it's a very important discussion. So I rather would say that you need to look into countries that were in a trajectory of improving the efficiency of their tax systems, and then sort of give them some points, reward them for the efforts that were already on course, and reinforce them with further support, because this is proving to be a very interesting development where you have a number of countries in Africa that are really eager to improve the efficiency of their tax system. And of course, you will start distinguishing countries between those who are rent seekers, that basically are comfortable, don't want to change, from those who are really making efforts despite having macroeconomic challenges. So if you bring these three elements, the discussion is a bit more comprehensive and I believe fairer.
Well, I think you've set up our next panel discussion for Togo at the Africa Financial Industry Summit. Hopefully we'll see you there as well. But I want to move on to something that came up in the middle of doing some homework around this particular panel, the question around whether or not African debt is fairly priced. And Aurélien, we're going to come to you because the ratings agencies come in for a lot of flack on this particular topic. And there was a report from UNDP released, I believe it was in April, that basically made the case that sovereign debt in Africa is often improperly priced, and they're saying that the three big credit ratings agencies are to blame. Where do you stand on that?
It's interesting because I've been visiting countries for 20 years throughout the continent, meeting governments on their policy objectives. And the victimization, I don't think, is the solution. Countries contracted the debt, they had plans, they did books, they did roadshow, they explained what they will do with the money, and now when it's time to reimburse, there is something like a complot or something, and it's unfair, and so on. People focus on the downgrades, but no one talks about all the upgrades and the positive actions that we take. We upgraded Côte d'Ivoire. We put a positive outlook. Côte d'Ivoire, we're in this country. It's a country that thought about the debt maturity, issued many times to reprofile its debt and to push it after 2030, so they don't face in Côte d'Ivoire because they thought about the management, the institutional knowledge, and the preparation was higher. We upgraded Angola. Angola has a positive outlook. It was a country that, it's over the 18 months, it's a country that did a lot of reforms. We changed the outlook on South Africa to stable from negative last year. We upgraded Benin. Benin that was the first country to develop a sustainable bond framework that explained how they are going to address some of the issues, and were very ready to be extra monitored on the way they will use proceeds to address these issues, to increase the trust they were trying to develop with the creditors. And so when we downgrade, we don't downgrade because we want to downgrade a country. There are reasons behind it. If you look at, for example, Tunisia and the difficulty to do an agreement with the official sector, it raises concerns because the situation is very difficult. Egypt has a gap of external funding over the next 2 years. And if they don't do the privatization plan, the agreement will probably collapse and they will default externally. Meaning when we take an action, we explain why, there is a rationale, we discuss, and therefore the ideas that one day someone wakes up and say, well, let's downgrade African nation is totally wrong. And so I think there is a need to recognize that, and I will finish on that there has been a period that were extremely favorable for borrowing externally. Countries jump in the wagon, they borrowed, and they didn't plan enough the future. I was in Zambia in 2010 or 11, and they just issued their first Eurobond, 10 years at 5-something%. It was lower than Italy at that time. And a young guy asked me, the rating is wrong, you rate us B1, our yields are lower than Italy. And at that time I said, borrowing is easy. but in 10 years, you will have to reimburse. And no one knows if the government will develop the sectors that will generate the hard currency to be able to repay. And we know all that Zambia defaulted. And it defaulted for many reasons. But what makes the situation, as I said, and I still abide by it, more difficult today is because the type of debt is different. It's less official, it's more private sector, and you have also the Chinese lending that supported some credit that makes more complicated restructuring of the debt. And we see that Zambia entered in the common framework from the last 2 years or 3 years, and it's still not solved. And so it's extremely difficult for a country like Zambia that cannot exit this default stage at the moment. So, I strongly object that it's because of the rating that the risk premium has increased. When Ghana defaulted, there is a contagion effect. When Zambia defaulted, Chad defaulted, Ethiopia entered in the common framework. It's not isolated. And investors, a portfolio manager, you have to understand that. A portfolio manager in New York, now that he gets 5% on the treasuries, do you think really that he's going to start to understand, okay, or they cannot raise maybe some enough money, or they extended themselves? It doesn't work like that. The issuers in Africa and everywhere else in the world will have to accept that the cost of money is more expensive going forward, because the risk for these savers, and you should not think themselves as funds. It's people money. It's the pension of a teacher or whatever. So they are very focused on the credit risk that they invest this money in. And so I think there are sovereign in Africa that are doing well, like the country we are at the moment, and they accept when they borrow the risk and the management. And I think that's important also to signal that.
Right. Mustafa and Ruud, I want to come to you on this next conversation, a question around, yes, there are pain points, but how do we restructure some of the debt that we have? How do we essentially try and remove progressively the FX risk that a lot of these borrowers are facing at the moment, right now, 5 years into the future, 10 years into the future? Ruud, you had an interesting proposal on how to change the structure of financial instruments that we essentially tap into in order to minimize that FX risk. Could you tell us about that?
Yeah, certainly, most happy to. And I think in order to tell the logic behind it, it's always nice to do a simple example, because all these debt discussions tend to become complicated quite rapidly. So if today the United States government would decide to fill the gaps, let's say, in their primary deficits with an issue in Swiss franc, the Minister of Finance would lose his job tomorrow. If the German government would actually decide to finance their huge climate finance ambitions with an issue in British pound, the Ministry of Energy would be on the street tomorrow. And these are governments that are well educated, well organized, and they have huge financial reserves. And the reason why these ministers would be on the street next day is they would create a debt structure that is unmanageable, unpredictable, and therefore unsustainable. Yet, in the financing of the most fragile countries, the choice is you either take the currency risk or you don't get a loan. If you look back over the last 2 years, so the debt to GDP increase for Sierra Leone was 50% purely induced by foreign exchange rate risk. For Ghana, it was 30% debt to GDP increase purely because of the FX risk. When Malawi decided to devalue 25%, the next morning their debt to GDP went up 8 percentage points. However, can you expect a government to manage its finances if their next month debt service is completely unpredictable? And that is why TCX reaches out to all the multilaterals, the African Development Bank, IDA, whoever is lending to these governments, to actually concentrate the FX risk in their own books, because they can generate a book with 50 different currencies, diversification. If one country tanks, it will be made up by the other ones. A single borrower will never ever be able to do that. So A, the FX risk does not belong with African borrowers. B, the institutions that have been set up to create economic growth and economic stability, they should take it because they have the knowledge, they have the tools, and they have the means from all their shareholders to manage it. So our proposal is actually pretty simple. Disburse the dollars or the euros because hard currency are needed by these countries, then swap it at local interest rates, and these will be higher than the current dollar rates, and concentrate all the risks in the book, either in Washington or in Abidjan with the African Development Bank or in Manila for the Asian Development Bank, because that should be the purpose in life for these institutions, to protect the borrowers from risks and not to give it to them because they cannot manage it.
Mustafa, do you want to weigh in?
Yes, you know, I came here at the heart of advisory firms to sovereign state. So one point was to defend governments when it comes to certain decisions. I think it's the decision we talk about, you know, borrowing in euros or the BOR and stuff like that. The other heart also is, you know, what I believe as someone who wants to be a good advisor is also to tell their clients what they're doing wrong. And I think all this discussion, we can have it for days, for years. But one thing that we have noticed in Africa is every time there is an external shock, the problem with FX risk is here, and debt repayment becomes an issue. I think there must be a huge focus in a point where whenever we talk about issues in Africa comes again, which is corruption. And the reason why I'm talking about it is, we mentioned earlier about tax collection. Why tax collections in Africa is not that efficient? Some might say informal sector, okay. But while we are structuring that informal sector, let's optimize the tax we are collecting, whether it's from customs, because we know that in Africa, main taxes are collected from customs and then corporate tax. But if you look at majorities of African countries, if I'm importing a car and I'm supposed to pay 10,000, the customer will say pay 2,000 and give me 1,000. Whereby if you pay 10,000, it goes to the government's account. If I am a corporate and I'm supposed to be paying 1 million, the tax authorities would say, okay, you know what, pay 1/3 of it or 1/4 of it, and you give me half of it.
I mean, sounds like you're structuring an argument here for cutting taxes.
Exactly. And if we put some, it's going to be a tough exercise, because I know the DFIs, you know, whether it's the World Banks, whether it's all these institutions, are really pushing governments to fight that corruption. But at some point, whenever you have an issue, you're the one who is dealing with that issue first before others come and help you. So, and for you, the best way to deal with this issue is to sit down, look at yourself in the mirror, and say, what am I doing wrong, and which is weakening me? And for me, the only issue I've seen across many African countries is the way tax collection is being handled through the corruptions.
So tax collection and spending efficiency, those are two key issues that need to be dealt with.
Absolutely.
All right. Webe, Ruud has some FX exposure he would like to sell you. There's no transaction fees being charged here, unfortunately. I'd love the dollars. Kenya needs the dollars, but I can't arrange the transaction in good conscience. But in reality, is that a deal structure that you'd be willing to engage with?
So I think it's important to step back and appreciate why it is that our countries borrow abroad to begin with. I think it's fundamental part of being a developing country that you don't have enough domestic savings. And there are various reasons, demographic, stage of development, etc. But in fact, our countries do not have sufficient domestic national savings. That's why they borrow abroad. But in question for this challenge, which Carlos will tell you about how governments fund themselves. We call it original sin, and why governments are unable to fund themselves in local currency and they have to go out and borrow abroad is the fact that either in the past that there has been this problem of having defaulted on domestic markets, so you're having to extend abroad, or more generally the domestic financial market is not large enough for you to tap, related to the point I was earlier making. So, when we think about how best to deal with this issue, I think the first and foremost and long-run solution is to try and develop the domestic financial sector so it becomes large and liquid, so that the government is able to issue all of its needs domestically. And it can be done. South Africa, where Carlos is based, is an example. I mean, I think they can easily finance themselves domestically. And funnily enough, that arose from the autarky, from the sanctions period under apartheid. They, I think for many years, have had this approach to financing 85% domestically and 15% abroad. And the issuance abroad really is just to, to create tenure for their private sector firms to borrow, etc. So it can be done. It takes time, but I think the fundamental solution, I think, is for countries to develop the financial sectors that they need to help fund themselves. I think that's a fundamental solution. Now, short of that, is there a case for somehow taking the FX risk off the balance sheet of countries? That's certainly something that I have not seen being done on scale. Second, also, I think there is an issue of incentive incompatibility. Okay, so in a way, kind of it gives a license for the government to not address the macroeconomic problems that are causing the FX to slide to begin with. Okay, so it's something that I think when Ruud is explaining it this way, it's something that would have to be thought of and addressed if you want to really this thing to be incentive compatible and help continue to improve the macroeconomic situation.
Yeah, just so two remarks, because it always, when I heard you say it's not been done yet, so that's very true.
On scale.
Yeah. The first loan to the government of France was the first development finance loan was to the government of France in 1947, a 30-year loan with almost 10-year grace. That's identical to the loans IDA is doing today. The world has changed in the meantime. But let's say some of the bureaucracies have difficulties catching up by adjusting their product to what we now have done in the financial world in terms of innovations. And then, speaking, let's say, for TCX, over the last 15 years, through 5 global financial crises, we took the FX risk on 70, 80 frontier market currencies, actually being able to sell to commercial investors, for example, the risk of Sierra Leone, Leones, but we took the risk of all these currencies on all these countries, and on a diversified basis, we're able to give our shareholders a tiny 2.5%, but still positive return. So what for individual countries is a huge challenge is not so difficult to turn into a viable business model. And I think that's the key message, to stop thinking in problems that currency risk is a problem. No, it's not. It's a business model if you handle it well, and you can actually resolve the FX risk globally based on a healthy business model. The only thing you need is innovate.
Mustafa, do you want to weigh in on that? Okay. Carlos, go for it.
No, it's not strictly on this point, but rather, when Aurélien was giving us a half dozen examples of positive outlooks, the difference is that these are not upgrades, these are outlooks. And the second reason is that, the whole of Africa, with 1 or 2 exceptions, is basically by the 3 rating agencies speculative. The entire continent is speculative. And a lot of it has, it's not because countries promised things and they wanted to do things when they were growing at some at 7, 8%, and then they couldn't actually implement it later, and now they are in default. Well, in fact, if you look into the continent as a whole, they didn't manage worse than, let's say, other regions, because Europe didn't see the pandemic coming. So a lot of things that happened there could have put, in terms of managerial efficiency of your debt, those countries in a worse position than the African position, because they were already above 100% of GDP. But it was fine because they could then borrow at 0% or even negative interest rates in some cases. That's what the Africans cannot afford. So let's admit that the problem is there, which is a problem of access to liquidity, no doubt. And from a rating agency's perspective, if you want to protect your customers, your clients, you have to admit that there is a problem of liquidity. So you are not going to lie. You are going to say, yes, the risk is now bigger than it was. And the risk is real, is not fabricated. But it's not because of performance. Let's be honest. It's not because of performance. You have cases where you can pinpoint that is the key reason. The major reason is actually external exogenous shocks. That's the main reason for not accessing liquidity. If you are growing at 8%, and then you have a pandemic, and then you have the war in Ukraine, and then, all of a sudden you find yourself in trouble because of the FX. This is not because of your management. So let's just be, reasonable in terms of why there is this feeling. It's not a feeling about plots. It's not about plots. You are doing your job. But the problem is that it's self-fulfilling. It creates the impression, well, of course, because the Africans cannot repay their debts, well, the outlook may be fine for 6 countries, but it will be worse for the next 20 or 30. We are in trouble. And we are in deep trouble because already access to liquidity is not possible for reasons that are very complex, but are very simple to explain. These are systemic reasons. The IMF can come with a number of new innovations and has attained record disbursements. But it's not enough, because the scale of the problem is a pandemic scale. It's a geopolitical polarization scale. And it's not the making of Africa.
Mustafa, you get the last word on this, and then we'll go into the floor for a couple of...
I just want to add something on to Mr. Lopez saying. When we get into the COVID, the pandemic, and right after the war in Ukraine, we've seen in the Western countries, central banks has injected a lot of money, printing money like crazy. Whereby in Africa, we don't have that luxury to print money to boost our economy. The only way we have to boost our economy basically is to have a sort of infrastructure plan where we need to borrow money. That's the only solution we have to fix the part of the problems that was caused by the COVID. If you tell us, okay, we have problems, but we are finding our solutions by printing money in a way that we've seen inflation the way it is in South Africa. Whatever our problem is imported. And you're telling us you cannot borrow money to solve these problems caused elsewhere that you have inherited. That is a bit frustrating. That's really frustrating. That's why what Mr. Lopez is saying, the problems, we cannot just focus in Africa with this issue right now. It's a global crisis, and we have to work together. What could have been a policy like 4 years ago if this problem would occur in a country like Ivory Coast or Nigeria? You cannot take the same solution to debt problems to now, because the problem now is global. There must be a more solidarity, more flexibility. I think there are some institutions like the OECD, for example. I can take that example on the export credit agency financing. The OECD now has moved from 85 on the coverage to 95. That way is to help African governments to lower the pressure. Another rules that they have taken, which is going to be published very soon, is the 10 years repayment on an infrastructure is going to 15 years plus. The 15 years for, let's say, water sanitation is going to be for 18 years.
So essentially a sort of de facto reprofiling.
These are decisions that we need to see more and more.
Right. I'm going to come to the floor now. If there are any questions to our panelists. Oh, okay, there's already one. Can we have a microphone? Are they moving around the room? Not yet. Okay, you're going to get mine.
Should I stand up? Yeah, sure. All right. Good afternoon. Polisa Philip from the Africa Report. I've got two questions. One is for Aurélien. It's about the refinancing terms for sovereign. You know, you mentioned that there will be a global tightening in terms of access to capital markets for African sovereigns. In terms of the terms of those refinancing, is there a creeping draconianism when it comes to the terms? Is there the possibility of sovereign assets being put up as collateral, possibly, in those refinancing agreements? And then the other one, when we talk about the African debt crisis, where do you locate the role of counter-cyclical fiscal spending in times of shocks in the domestic context, where citizens are faced with increasingly harsher macroeconomic conditions? Thanks.
Okay, so if I understood the question, the role of countercyclical financing, so a bit of spending in terms of crisis, but also on top of that, the potential of assets being essentially held as collateral when we are talking about refinancing deals with our creditors, right? Okay, perfect.
Thank you for the question. For the asset as collateral, there are a few examples of countries that have pledged, assets to borrow money. I think about the transaction called Sicomin in DRC, where there was an envelope that the government could use to build infrastructure via a Chinese company. And in exchange, they did a joint venture to exploit copper with the 50% of the government will repay over time. There has been assets that have been confiscated in Sri Lanka, for example, for the debt default on China, a port that has been nationalized or by China, if you want. But it's not the way, the financial transaction on financial market works. You have a default, you have a restructuring, and generally that's it. But the important point is that the default generally is extremely severe in terms of pain for the population, for the economy. You face generally depreciation of the currency, capital outflows, and so on and so forth. Now, for your second question on the tightening of the capital market condition, it is happening. This is the slide where I show that the yields for African sovereign diverge from the rest of their peers, and probably it will be over when the Fed will stabilize its interest rate. So it's happening as we speak. And because we have countries that are getting in a more difficult situation, their yields are going up as well.
You happy with that? Yeah. There was a question on countercyclical spending as well. Yeah. Okay, go for it.
Yes, sorry, I forgot about it. This is important, very important, and we try to, for the rating agency's perspective, at least to ride through the cycle. So, for example, this country, Côte d'Ivoire, to give you an example, forego 1% of GDP as tax revenue because they gave up the tax on oil and oil taxes on product. And it was clearly to avoid and support the price when you had the energy crisis. And this is part of the tools, but for countries that are really indebted, they don't have this flexibility because there is no flexibility in the budget anymore.
No, I was just on counter-cyclical fiscal policy. There has been some counter-cyclical fiscal policy in the region in the context of the pandemic, but nothing, of course, on the scale that we saw in the West. So 2020, we estimate that advanced countries were supporting their economies to the tune of about 9% of GDP. emerging market countries to the tune of 6% of GDP, and low-income countries only about 3% of GDP. So a third of the amount of counter-cyclical support that advanced countries were able to put in place. And this, again, was almost directly correlated with the size of the domestic financial market, ability of government, because, you know, most countries were cut off from external financing. So that's the limit at which they were able to tap domestic markets. And even that only because the private sector also had withdrawn from business activity for obvious reasons. Now, there was some support, of course, from institutions like mine. About a third of that about 1% of GDP was, the safety net that we provided across the region. But that is also a sore point, and a valid one, because one issue we have, the scarring that we face now in education, in health, failing to recover as quickly as advanced countries have, is also a result of the limited extent of the counter-cyclical policies that our countries were able to pursue.
There's a gentleman to my right, sorry, to my left.
Thank you very much, and well done for the panel. It's very interesting. My name is James Moria from Kenya. I wanted to pick up on a point that was made by Abebe on the IMF. We are where we are in terms of solutions. And one of the solutions that has been recommended for Kenya is to increase tax rates, be more vigilant on collection, and increase interest rates. The assumption is that our tax to GDP has not kept up because of poor collection and people evading. But it ignores something missing. Taxes don't come from GDP, they come from employment. So if you look at the employment to GDP ratio, although our GDP has gone up, employment has not kept up. It has actually come down. And that's because of the structure of the debt we've taken. A lot of this debt has gone into infrastructure, and it has been tied by the lenders to us sourcing that infrastructure from the lending country. And therefore, what we received is a physical asset, which is now counted as GDP, and is therefore not contributing to employment. Now, my concern is around these recommendations. Maybe it's actually they'll make things worse. Because as you increase interest rates and you increase taxes, you're reducing our competitiveness. And as we open up our economy, and as we speak about moving from 300 to 3,000, why would I invest in a country where you have such a high tax environment, both as a producer and for my consumers? Taxes are high, cost of borrowing is high. Why invest in that country? And so how will that help us in resolving the issue? I think the missing conversation here is the issue of competitiveness and productivity to drive employment so that then we can drive taxes to be able to pay these debts. And I think the IMF should be focusing around what tools can we put around to lengthen the tenures, because we borrowed short-term for infrastructure funding, and to mitigate the FX risk, rather than necessarily driving us further down the uncompetitive route. Thank you very much.
All right, then. That's for you, Abi.
I think...
It's okay, you can applaud. Go ahead. These are the conversations we're here to have.
Of course. And I thought I was far away from Kenya to not face questions on Kenya. But, so, a few thoughts perhaps. First and foremost, I think this point that I made about this fiscal trilemma that our countries face first occurred to me in Kenya around 2016-17 and those were the good times, no? When economy was still growing and there was no debt issue. But I was struck by how much resistance there was in Parliament to raising revenues, even when the economy was growing and on a glide path, which seemed very reasonable. There was tremendous pushback. And the then minister, cabinet secretary, was also facing tremendous pressures to continue investing in infrastructure. So that pressure was relentless, and of course, everybody in the social media and elsewhere complaining also about that country's debt level is going up. And I was struck by how much there was this lack of recognition of our own agency as Africans, as countries, as governments. Huh? I mean, and also, I felt sorry for the CS because how is he going to survive? Huh? Nobody wants to pay taxes, nobody wants spending to be cut, and nobody wants debt to go up. How our countries manage this trilemma will determine whether we have countries that, are grown up, that are mature, that are addressing their economic difficulties as they are occurring. So I think that's the broader point that I was making earlier. Now, so on the specifics of how Kenya can best navigate where it is now, because the debt pressures have gone up on account of the exogenous shocks that the country has faced. What gives us comfort, or the direction of travel the government has chosen, is that the deficit, the primary balance is moving to the level that is sufficient to stabilize debt. Okay, I think that adjustment, that effort has taken place. A bit more needs to be done, but the direction of travel, I think, is the right one. So the challenge is a little bit more the liquidity side rather than the solvency side in Kenya. That's our considered view. Of course, this is all dependent and contingent on all of the macroeconomic variables that we are forecasting going forward, and that's how we do the work. Now, in this context, again, I go back, I traveled to Kenya for the first time ever for the IMF. I'll age myself if I tell you, but I'm not going to hold back. I first went there in '95. And I was so impressed relative to my country, where I had been working only a couple of years earlier, just how significant the tax collection is. And I've traveled across the region, worked in the region, and the Kenyan economy is now multiples more resilient, robust, much more sophisticated, and the tax to GDP ratio has gone down. Surely this cannot be the case.
But I think the gap between your position and James's position, because he runs,
Okay, let me finish, please. So the point we're making is that, if Kenya wants to sustain the level of spending, the level of economic activity that it wants to engender, it is going to have to mobilize tax revenues domestically. It has to do that. It cannot just be on borrowing terms. And then second, on this current juncture, we are, of course, stepping in and providing quite significant financing, exactly with a view to giving the government more time to address, and move forward with the economic difficulty. So, the point that you're making about the need for more liquidity is exactly what the IMF, the World Bank are providing at this moment.
And I guess, and correct me if I'm wrong here, James, because the argument he's making is that, to what extent, because when we keep hearing that drumbeat of raise taxes, you need more tax revenue. And yet, if you look at, and I'm just using the Kenyan numbers off the top of my head here, if you look at formal sector job creation as a proxy, right, that's been going down for years.
So, I think, so there is a question about, is our economic activity now more capital intensive than before? And I'm not sure. I don't know. I mean, it's something that, of course, is worth studying. But a broader question is is the share of employment in labor, economically active population as a share of the total also less than it was before? I'm not sure. Now, if we are indeed saying that there's more capital intensity, there is that, basically says that you should have more of a tilt toward taxing capital over labor, right? It doesn't preclude higher level of taxes. Your economy structure has changed, so you should be moving towards taxing the capital more. I go back to the point that Carlos made. I think there is an issue that we do have perhaps not sufficient grasp of, what the structure of the economy is, and we need to find new tax tools. But I think the overall direction of travel, I think, is clear. And then last point I want to make is that, for many, many years, unfortunately, there's also been a self-inflicted aspect to why revenues are poorer, which is governments providing year after year tax exemptions in the hope that to attract businesses, etc. And I think that's been shown to be a fool's errand in many, many cases.
Carlos, and then we'll go back to the floor.
I just wanted to put a small footnote. Let's not forget also devolution in Kenya. The debate about devolution has not helped tax collection because it's basically, political imperative that I can understand, but has created a bit of a problematic move towards more efficiency on tax collection.
Is there any other question from the floor? Anything? Going once, going twice? Last time, you don't have to pay in dollars or Bitcoin, thankfully. Well, Bitcoin would be nice, though, if you could actually get it. Yeah, but gentlemen, thank you very much for your time and your attention. They will, of course, be around for the remainder of the event, so fire away at all your questions at my panelists. Thank you very much for your time and your attention. We'll see you in the next one.